Is the TMF ETF right for you? 3x leverage, risks benefits. Hey everyone, welcome back to Chat ETF. Today we're diving deep into a fascinating, but potentially risky, corner of the ETF world, the TMF ETF. This bad boy promises to triple your daily returns on long-term treasuries. Sounds amazing, right? But before you jump in, there's a lot to unpack. We're talking leverage, volatility, and some hidden risks you might not be aware of. So, is the TMF ETF a chance to supercharge your portfolio, or a recipe for disaster? Let's chat about it. Question 1. What is the specific underlying index tracked by TMF ETF? The TMF ETF, also known as the Direxin Daily 20+ Year Treasury Bull 3x Shares ETF, doesn't directly track a stock index. Instead, it aims to achieve 300% of the daily performance of a specific bond index, the ICE U.S. Treasury 20+ Year Bond Index. Here's a breakdown. Target, daily performance. TMF focuses on delivering daily returns that are 3x, what the ICE U.S. Treasury 20+ Year Bond Index delivers. This means if the index goes up by 1% in a day, TMF should theoretically go up by 3%. Conversely, if the index goes down by 1%, TMF could decline by 3%. Underlying index, ICE U.S. Treasury 20+ Year Bond Index. This index tracks the performance of a specific segment of the U.S. Treasury bond market. It includes bonds issued by the U.S. government with maturities greater than 20 years. The index performance reflects the average price movement of these bonds. Key takeaway: while TMF doesn't track a stock index, it uses the ICE U.S. Treasury 20+ Year Bond Index as a benchmark to achieve its objective of magnified daily returns on long-term U.S. Treasury bonds. Important to note: TMF uses financial instruments like futures contracts and swaps to achieve its 3x leverage. This magnifies returns, but also magnifies risks. TMF focuses on daily performance, and due to compounding effects, its returns may deviate from 3x of the index over longer periods. Question 2. How does TMF ETF rebalance its leverage on a daily basis? TMF, the Direxin Daily 20+ Year Treasury Bull 3x Shares ETF, utilizes a process called daily rebalancing to maintain its target leverage ratio of 3x the daily performance of the ICE U.S. Treasury 20+ Year Bond Index. This rebalancing is crucial because several factors can cause the actual leverage ratio to drift away from the target throughout the day. Here's a detailed explanation of how it works. Why rebalancing is necessary. Fluctuating asset value. The total value of TMF's holdings, assets under management or AUM, can fluctuate throughout the day due to changes in the underlying bond prices. As bond prices move, the value of the ETF itself changes. Inverse price-leverage relationship. There's an inverse relationship between the price of the underlying bond index and the required leverage to achieve the target return. When the bond prices go up, the ETF might need less leverage to achieve the 3x return, and vice versa. The rebalancing process. 1. Monitoring and measurement. Throughout the day, the ETF manager continuously monitors the following. Current price of TMF. This reflects the current market value of the ETF shares. Current price of underlying index. This is the real-time price movement of the ICE U.S. Treasury 20+ Year Bond Index. Total assets under management, AUM. This represents the total value of all the ETF's holdings. 2. Calculating leverage ratio. Using the above data, the manager calculates the current leverage ratio. This ratio represents the actual leverage obtained by the ETF's current holdings compared to the target of 3x. 3. Taking action to maintain target leverage. Oh, if leverage is below target, less than 3x, this indicates the ETF isn't aggressive enough in magnifying returns. The manager might purchase additional futures contracts or swaps on the underlying bonds. These instruments provide leveraged exposure to the index, amplifying the returns. Oh, if leverage is above target, more than 3x, this suggests the ETF is over-leveraged. The manager might sell some of the existing futures contracts or swaps. This reduces the leverage and brings it closer to the 3x target. Important points. Rebalancing frequency. This typically happens daily, usually in the morning, before the market opens. Rebalancing at the close wouldn't reflect the full day's price movements. Impact on investors. Daily rebalancing can lead to small tracking errors between TMF's performance and the 3x multiple of the underlying index, especially over longer periods. This is because rebalancing itself involves buying and selling securities, which can incur transaction costs. Focus on daily performance. TMF targets a 3x magnified daily return of the index. Due to compounding effects, the returns over extended periods might deviate from a perfect 3x multiple of the index. In essence, TMF's daily rebalancing is a continuous effort to maintain the desired leverage ratio and achieve its objective of magnified daily returns on long-term U.S. Treasury bonds. However, it's important to understand the limitations and potential tracking errors associated with this process. Question 3. Are there alternative leveraged Treasury ETFs with different structures or expense ratios? There are alternative leveraged Treasury ETFs with different structures and expense ratios to TMF, directs in daily 20+ year Treasury Bull 3x shares. Here's a breakdown of the available options and key considerations. Leveraged Treasury ETF landscape. Multiple leverage ratios. While TMF offers 3x leverage, other leveraged Treasury ETFs can provide different levels of magnification, such as 2x or even higher. Be cautious of extremely high leverage. Different underlying indexes. TMF targets the long-term Treasury bond market, 20+ years. Alternatives might focus on shorter maturities, e.g., 7 to 10 years, through different underlying indexes. Varying structures. Not all leveraged ETFs achieve leverage in the same way. Here are two main structures. Futures-based leverage. Similar to TMF, many leveraged Treasury ETFs use futures contracts to magnify returns. This is a common and relatively transparent approach. Option-based leverage. Some ETFs utilize option strategies to achieve leverage. While potentially offering more flexibility, option-based structures can be less transparent and potentially more expensive. Expense ratios. The cost of managing a leveraged ETF is reflected in its expense ratio. Generally, leveraged ETFs tend to have higher expense ratios compared to non-leveraged Treasury ETFs due to the complexity of managing the leverage. However, there can be variations between different leveraged Treasury ETFs. Important considerations before choosing an alternative. Risk-reward trade-off. Leveraged ETFs magnify returns, both gains and losses. Carefully assess your risk tolerance before investing in leveraged ETFs. Understanding the structure. Familiarize yourself with the specific structure, futures-based or option-based, used by the ETF to achieve leverage. Expense ratio comparison. While not the only factor, expense ratios can impact your long-term returns. Compare expense ratios of different alternatives. Investment goals. Align your choice of leveraged Treasury ETF with your overall investment goals and risk profile. Question 4. How does TMF ETF perform in different market environments? TMF, the Direxin Daily 20+ Year Treasury Bull 3x Shares ETF, exhibits amplified performance compared to the underlying bond market depending on the specific market environment. Here's a breakdown of how TMF performs in different scenarios. TMF performance in bullish markets, rising bond prices. Amplified gains. In a bull market for long-term U.S. Treasuries, when bond prices rise, TMF is designed to deliver 3x the daily return of the ICE U.S. Treasury 20-plus year bond index. This translates to potentially significant gains for investors. Example: if the underlying index goes up by 1% in a day, TMF should theoretically gain around 3%. This magnified return can be attractive for investors seeking to capitalize on a rising long-term Treasury market. TMF performance in bearish markets, falling bond prices. Exaggerated losses. The flip side of amplification is that TMF also magnifies losses when the underlying bond index experiences a decline. A drop in long-term Treasury prices can lead to significant losses for TMF investors. Example: if the underlying index goes down by 1% in a day, TMF could experience a decline of around 3%. This magnified decline can be detrimental to investment portfolios. Additional factors to consider. Volatility. TMF's daily rebalancing can lead to amplified volatility in its returns compared to the underlying index, especially during periods of high market swings. Compounding effects. While TMF targets a 3x daily return of the index, due to compounding effects, its returns over longer periods might deviate from a perfect 3x multiple of the index. This can be because rebalancing itself incurs transaction costs. Decay over time. In sideways markets, where prices stagnate, TMF's returns might underperform the underlying index over extended periods due to the effects of compounding and fees associated with rebalancing. Overall, TMF is a leveraged ETF that amplifies returns, both gains and losses, in the long-term Treasury market. Its performance is highly dependent on the direction of the bond market. Here are some key takeaways. TMF can be a tool for magnified gains in a rising long-term Treasury market, but comes with the risk of magnified losses in a declining market. Understand the inherent volatility associated with leveraged ETFs like TMF. TMF's performance might deviate from a perfect 3x multiple of the underlying index due to compounding and rebalancing effects. Question 5. How does TMF ETF's liquidity compare to other Treasury ETFs? TMF ETF, Direxin Daily 20-plus year Treasury Bull 3x Shares ETF, generally has good liquidity compared to other leveraged Treasury ETFs, but it might be lower than some non-leveraged Treasury ETFs. Here's a breakdown of the factors affecting TMF's liquidity and how it compares. Factors affecting TMF's liquidity. Trading volume. TMF is a relatively popular leveraged ETF with a decent average daily trading volume. This translates to a higher number of shares being bought and sold daily, which enhances liquidity. Underlying asset liquidity. The underlying asset for TMF is the ICE U.S. Treasury 20-plus year bond index. The U.S. Treasury market is generally considered highly liquid, which contributes to TMF's liquidity. ETF structure. Leveraged ETFs, like TMF, can have slightly lower liquidity compared to non-leveraged ETFs due to their complex structure and the use of derivatives, like futures contracts, to achieve leverage. Comparison with other Treasury ETFs. Non-leveraged Treasury ETFs. Generally, broad non-leveraged Treasury ETFs that track major Treasury bond indexes tend to have higher trading volumes and even better liquidity than TMF. This is because they cater to a wider range of investors and often have lower expense ratios. Other leveraged Treasury ETFs. The liquidity of TMF can be compared to other leveraged Treasury ETFs with similar leverage ratios and underlying indexes. By using financial websites, you can screen for leveraged Treasury ETFs and compare their average daily trading volumes. ETFs with higher trading volumes typically have better liquidity. Liquidity considerations for investors. Impact on order execution. High liquidity generally translates to smoother order execution, meaning you're more likely to get the desired price when buying or selling TMF shares. Bid-ask spread. The bid-ask spread represents the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share. TMF's bid-ask spread might be slightly wider than highly liquid Treasury ETFs, but it shouldn't be significantly different. Overall, TMF offers good liquidity compared to other leveraged Treasury ETFs, but it might be less liquid than some broad non-leveraged Treasury ETFs. When investing in TMF, liquidity should generally not be a major concern, but it's still a factor to consider, especially if you plan to trade large amounts frequently. Question 6. What are the potential risks of Contango, negative roll yield, associated with TMF ETF? TMF, the Direxon Daily 20-plus year Treasury Bull 3x shares ETF, uses futures contracts to achieve its leverage objective of 3x daily returns on the ICE U.S. Treasury 20-plus year bond index. However, this strategy exposes the ETF to a potential risk called Contango, negative roll yield. Let's delve into how Contango works and how it can impact TMF's performance. Understanding Contango. Futures market and normal roll yield. In the futures market, contracts typically exhibit a normal roll yield. This means nearby futures contracts, expiring sooner, are usually priced lower than futures contracts further out, expiring later. This pricing structure incentivizes investors to roll over their expiring contracts, buying a further out contract and selling the nearby one, at a small profit. Contango, negative roll yield. However, in certain market conditions, the opposite can occur. The nearby contract can be priced higher than the futures contracts expiring later. This situation is called Contango or negative roll yield. Impact of Contango on TMF. TMF's reliance on futures contracts. Since TMF uses futures contracts to magnify returns, it's constantly rolling over expiring contracts to maintain its desired leverage. Erosion of returns due to negative roll yield. During Contango, when TMF rolls over expiring futures contracts at a loss, buying higher and selling lower, it eats into the ETF's overall returns. This effect can be amplified for leveraged ETFs like TMF, because the negative roll yield is compounded over time. Important considerations. Contango is not always present. The futures market can exhibit normal roll yield or Contango, depending on various factors like interest rates and market expectations. Impact varies over time. The severity of Contango's impact on TMF's performance can fluctuate based on the duration and magnitude of the negative roll yield. Difficult to predict. Predicting Contango is challenging, making it difficult to perfectly time entries and exits from TMF to avoid its negative effects. Mitigating the risk of Contango. Limited effectiveness. There's no foolproof way to eliminate Contango risk entirely for TMF investors. Understanding historical trends. Analyzing historical Contango patterns in the Treasury futures market can provide some insights, but not guarantees, about future Contango environments. Alternative leveraged ETFs. Exploring leveraged Treasury ETFs that achieve leverage through different methods, e.g., options, might offer some diversification, but they come with their own set of risks. Contango is a potential risk for TMF due to its reliance on futures contracts. While not always present, Contango can erode TMF's returns over time. Question 7. How does volatility decay impact the long-term performance of TMF ETF? Volatility decay is a significant factor that can negatively impact the long-term performance of TMF, the Direxon Daily 20-plus year Treasury Bull 3x shares ETF. Here's a breakdown of how volatility decay works and how it affects TMF. Understanding volatility decay. Daily targeting versus long-term compounding. TMF aims to deliver 3x the daily return of the underlying Treasury bond index. This means it focuses on magnifying short-term movements. Impact of daily up and down swings. Over longer periods, market movements tend to even out, with periods of gains offset by periods of losses. However, due to the compounding effect, volatility in these daily returns can negatively impact TMF's long-term performance. The compounding effect and TMF. Magnification of losses. During volatile periods with frequent price swings, even small daily losses in the underlying index can be magnified by TMF's 3x leverage. This compounded effect can lead to a more significant decline in TMF's value over time compared to a straight 3x multiple of the index return. Example: imagine the underlying index goes down by 1% on one day and then gains 1% the next day. In a non-leveraged scenario, the investor would be back to square one. However, for TMF, the 1% loss would be magnified to 3%, and the subsequent 1% gain would only be magnified to 3%, resulting in a net loss despite the index returning to its starting point. This highlights how volatility can erode returns over time. Factors affecting volatility decay. Frequency and magnitude of price swings. More frequent and larger price swings in the underlying bond market exacerbate volatility decay for TMF. Holding period. The longer you hold TMF, the greater the potential impact of volatility decay on its returns. Mitigating volatility decay. Limited options. Unfortunately, there's no way to completely eliminate volatility decay for TMF investors. Understanding the risk. Being aware of volatility decay and its potential impact on long-term returns is crucial before investing in TMF. Considering alternatives. Investors seeking long-term exposure to Treasury bonds might be better suited with non-leveraged Treasury ETFs that accumulate returns without the magnifying effect of leverage. Question 8. How would a sudden rise in interest rates affect TMF ETFs holdings and returns? A sudden rise in interest rates would likely have a negative impact on TMF, the Direxin Daily 20+ Year Treasury Bull 3X Shares ETF, due to its holdings and its leveraged structure. Here's a breakdown of the effects. Impact on TMF's holdings, long-term Treasury bonds. Inverse relationship between interest rates and bond prices. Generally, there's an inverse relationship between interest rates and bond prices. When interest rates rise, existing bonds with lower fixed interest rates become less attractive to investors seeking higher yields from newer bonds with prevailing market interest rates. Price decline in long-term Treasury bonds. As a result of a sudden interest rate hike, the prices of long-term Treasury bonds, TMF's holdings, are likely to decline. The longer the maturity of the bond, the more sensitive its price is to interest rate changes. Since TMF focuses on the 20+ year Treasury bond segment, it's particularly vulnerable to these price drops. Impact on TMF's returns, amplified losses. Magnified decline due to leverage. TMF targets a 3x daily return of the underlying index. So, if the long-term Treasury bond index experiences a price decline due to rising interest rates, TMF would amplify those losses. A 1% drop in the index could translate to a 3% decline in TMF's value. Potential for further losses. Depending on the severity and persistence of the interest rate rise, TMF's losses could be substantial. This magnifies the risk for investors. Additional considerations. Interest rate expectations. The impact of a sudden rate hike on TMF depends on market expectations. If a rate hike is already priced in by the market, the effect might be muted. Volatility increase. Rising interest rates can lead to increased volatility in the bond market, potentially exacerbating volatility decay for TMF, discussed previously. Overall, a sudden rise in interest rates presents a significant risk for TMF investors due to the potential for magnified losses in its holdings of long-term Treasury bonds.